Hello. Would be at 6 or it's 6:10, because the time changes every time.
In the letter from Uliana, time is 6, but last Friday it was 6:10. Maybe it is misleading a bit.
Yeah, for the first lecture it was 6:30, I believe. Then it was 6:10 last time, and now I saw that the time for the conference set in Zoom 6. So I'm a bit confused by that. Okay, let's just wait for some other students and we'll begin. Looking at the number of participants now, I believe that the time people now is 6:10 probably. So we'll wait until 6:10, and in 5 minutes we'll start. So I'm switching now, and we'll begin at 6:10. Okay, let's get started. I still don't see too many students here. I'm not sure about the time you have, but I asked managers and they said that 6:10 is official time, so it's time to start. Well, let's first check that we are on the same page about your projects. 1 second. This is the list of students and projects I have. I see like 30 students here with 27 projects. Anton, Stepan, Yelizaveta, if you're here, I'm still waiting for your projects, for your topic. But you have already sent me your first drafts, your first parts of your models. So I believe it's time to discuss something about how you should approach your models and what you should think about when you start building your models. And I'd like now, after you started your work, return to a question of style. Let's look at several models, and I will show you with these examples how different styles could be used or shouldn't be used to present your project, your ideas, and so on. And to do that, I will show you 3 different financial models for 3 different projects. The projects are pretty similar: 2 power plants, 1 highway, but the models are very different. The first model will be a typical model that I see when somebody sent us a model and asked to rebuild this model because nobody can understand what's going on here. And this is a model of some hydropower plant. And look at this model. Can you understand, or can you read this model? Can you understand what's going on here? It starts with some capital investments information, but you cannot actually see where is their calculations and where are their input data, because you can see that this is a mix of some numbers, some calculations, and so on. Then we go further, and the next part here, it's like initial data for the project. Then we have power generation tariffs, but the space is used in a very strange manner. They have blank parts of the sheet and so on. Then they have fixed annual costs, our expenses. We cannot guess how they use colors here. Then scenarios, then capital investments, total investments, financing. And again, I have no idea what those colors mean actually. Consolidated financial reports, but in those financial reports, it's very hard to understand. This is actually not financial reports. This is the cash flow statement. And we have a standard normal name for the cash flow statement. It's this cash flow statement. So if you have somewhere cash flow statement, then please name it this way, name it straightforward, so that anybody could understand what's where in your financial model. Then sensitivity analysis, and again, it's a mix of color, sports, and so on. Then the revenue from electricity generation. There are two parts here because any power plant in Russia or in some other countries can sell electricity and capacity. This is a two-part tariffs. So this is a typical model where people were building the model in the order as they were thinking about different parts of their project. And as the result, nobody could understand it. So this is this is how your model should never look like. Because if you build models like that, you actually destroy your business reputation by this type of work. Okay, let's close it. Now, I will show you something that should be like an ideal, perfect financial model for a project. This is actually, that was prepared as a demo model. It calls smart methodology. They actually stopped using this smart name. Now it's just how is sorry, the company. It was Corality, and then Corality was bought by another company. The name, it doesn't matter. Let's call it Corality. So it's a company specialized in project finance. So they were trying to build a perfect model and a demo for their work. Here, we start with some summary. Then financial statements. They actually build this model by months, but they collected all information in years. So they start with annual financial statements, then it's financial statements by months, then their scenarios and inputs. A bit maybe inconvenient flow of information for myself, but sometimes it's okay to walk this way. So to start with financial reports with some summary, and then we go to our inputs and then our calculations. So in their model, they made it like a very convenient model where all input data is on the same sheet called inputs. So you can easily see all the initial data. Then they go to calculation sheets. Start with timing, then the construction or CapEx sheet. All CapEx is calculated here. Then OpEx and revenue, actually. Then financing, all their loans and so on. And accounting, like depreciation, taxes, and so on. So they have actually the flow of information in this model starts with inputs, Then it goes to 5 calculation sheets. Then it goes to monthly financial reports, then to annual financial reports, and then to summary. And to make it easier to navigate through all that, they actually recommend to build something like this model flowchart. It would help to find all necessary information on your model. So you can work this way. This is another and very popular style for your model. And think about this flowchart as a way to help people to find anything on your model. The third possible approach, that would be, that's like my style. For my style, and this is the style I'm showing you on my lectures. Again, I start with something like summary. This summary will be necessary for most models, for most projects, because people would like to find key information in your model instantly. They don't want to learn on the model, to analyze all the model. Most users of your model will not have time to dig into the model. So they want to see all important information instantly, and only some of them will go deeper and analyze the whole model. Then we have some macro information, and just like in the model where that we used in the course, I combined some technical flux with macro information, but you can split them into 2 different worksheets. So I started with inflation, with tax parameters, discount rate, although actually I think that maybe discount rate is better to place it into analysis tables closer to the use of these discount rates. Then we have, just like with the model we discussed last time and the model we'll be discussing today, we have our input and preliminary calculations sheets. Why I don't use this input sheet just like Corality does it? Because in the projects I usually work with, I see that people have too many input data parameters to place them on a separate sheet. We need a structure, just like here or in our models, we put all our sales here and all calculations for the reports are at the end of this section. The next is our raw materials, then personnel plan, then operating expenses, and so on. And you have a choice. You can put any of this table on a separate worksheet if you have too much information for this section. So we have this input data for the project and all necessary calculations within these pods. As I said, for many cases, you will put some sections on separate sheets. And then we have reports. And for financial reports, a good style, and this is the topic for today, a good style is when no additional calculations, no analysis is put on this sheet. For example, here you can see that some other parameters used here, this is not just a direct link, but actually, if you check this parameter, you will see that this is just a currency rate. Just because in this model, you can switch financial reports from one currency to another currency. And this is the only calculation done here. And then we can do our additional analysis, then we can add scenario analysis and so on and so on. But the idea is like that. And this model, this is quite a complicated model with sometimes with very, I can show you an example, with a very, it's not here, it's here, with very large formulas like this one. This is not a good style. This is a very bad style. If you build formulas like this in your model, this is very bad. Why it's here, such a formula? Because it wasn't a model created specifically for this project. That was a template, a universal template used for many projects that can be rebuilt for any project, for any kind of project. That's why, because of this universal approach, some formulas are too complex. But even with this problem, this is definitely an issue for the model. But even with those issues, you can easily find where to start. You start here, you see all the important information. You can always see where this number is taken from. It's from reports. Okay, we go to reports and we can see all normal standard financial reports. Then we can go deeper. For example, where we take sales revenues from, it's from project. Now we can go to project sheet, and on project sheet we can see that all the sales are here and so on. This is the style you should implement in your models. Although you have choice, you can put all inputs like in a correlative model on a separate sheet. You can restructure it in any style, the most convenient for your project, but the general idea should be the same. Well, okay. Now, imagine that you open a model or a set of financial reports, maybe prepared a very good, but very complicated, very complex, sorry, and not easy to study. Take, for example, such a report. This is a financial report. That's actually analyst handbook for Interau. Interau is a Russian energy company, and this is a public company for analysts who analyze this company. It publishes not just annual reports or financial reports, but also an Excel model with all useful information for all analysts. And when you see this model, how do you read it? Where do you start? You can see that on the table of contents, we have a lot of, that's actually not reports, this is a sets of reports, because if you go for something like Russian generation, you will see that actually in Russian generation, you have a lot of worksheets with various information about generation. So it's hard to navigate through this model. And by the way, just in case you don't know, in the models like this, where they have dozens of sheets, you can quickly jump to any worksheet. If you click right button of your mouse on these arrows at left of the list of sheets, so you can see how many sheets are there. It's really hard to navigate through this model. So where all people start with all financial models? Of course, somewhere where they expect to see something standard, something easy to digest, and that's financial statements. And if you work with your model, when you will be building your model, think about that. You can build your project, you can develop your model in any way the most natural for your business, for your parameters. But your financial reports should be as standard as you can, because that helps people to read your model. So if we start with financial reports, we do income statement, and yes, we can understand anything here. We understand all the lines because they all standard. We can then jump to the cash flow statement. Cash flow statement here, because this cash flow statement is very complex. They first started with a brief version of the cash flow statement, and then they presented each of three sections: operating, investing, and financing cash flows as separate sheets. I personally don't like this style, but they did it this way. Balance sheet or financial position statement is the third financial report, and after you hear in this financial report statement, you start understanding what's going on with this company, with all calculations. And actually, this is the way people look for all information they need in financial models. They start with the reports, and they backtrack to the initial data, to the inputs from the lines of financial reports. So this is the way we're going to read the models, and this is the way we're going to build the models. Now let's go to our financial model. Last time we stopped here. We built our input data and all intermediate calculations, and we stopped actually after capex, yes, after fixed assets. We didn't fill tax payments. We'll return to tax payments later, but now let's go to our financial reports. And again, I will use a field model just to save time for now. Well, our financial reports are three reports: income statement, cash flow statement, balance sheet. And a good financial model should contain all three financial reports. In some cases, like if you don't have a lot of data on capex, if you don't use loans, if you don't have significant amount of working capital, you can actually skip cash flow statement and the balance sheet and keep just the income statement. And that could sound strange because for projects, the cash flow statement is the most important financial report, right? Because the most important indicators for us are things like net present value or internal rate of return, and we calculate them all from the cash flow statement, right? But this is not the way, this is not the order in which we create our financial reports. And you'll see later why. So if we don't have a lot of data, enough data to fill all three financial reports, then probably we keep just the income statement. And we'll build free cash flow in addition to this income statement. Okay, how do we build this income statement? It actually has a standard structure, and our income statement, I mean, the income statement in the financial model for a capital investment project isn't exactly the same as the income statement in financial reports of just companies. Let's open again this analyst handbook for Interau and look at its income statement. Financial reports, income statement. Okay, so here you can see that we can actually hide many things here. This is the details we don't have in projects, because things about how we have revaluation or details about shareholders and so on are usually not modeled in a financial model for a project. So we hide it. So this is a typical financial report for an actual company. We start with revenue, maybe some other operating income. We don't have other operating income again in our investment projects, just because we model one project, one thing. We don't work with a diverse large business with many non-core operations. So we would have something like this: revenue, operating expenses, then we have operating profit, again something unnecessary for us, then finance or financial income. We won't have financial income in the project. Why? Because we invest money in this project. We don't model in this case. We don't model things like I don't know, financial investments or other companies and so on. We have just this project. So we would have just finance expenses. This is like interest paid for our loans. Again, we don't have subsidiaries. So that's how the financial report would look like if we did it like the companies do in their financial reports. It's not enough to have something like this. Why? Because let's go back to our project. Because when somebody uses our financial reports, as I said, each line of this report is a starting point for them to analyze this type of information, this type of expenses or income in the project. So first of all, each line here should lead to a separate section in our financial in our project, like sales revenue. Okay, what is sales revenue in this project? We can see it's project line 38. Project line 38 is the line, the finishing line in this section, sales. So anybody who understands what financial reports are can easily track all calculations in your model. I don't need a special knowledge about how you develop this model, how you believe your information had to be collected for this project. I just start with something well known, like the income statement, and each line of the income statement leads me to the necessary section in your model. So this is the good style for modeling. And you can see that each line here has just one link to one separate section. Next important thing in my income statement, I don't like to mix like in this operating expenses. This operating expenses is a mix of something that I paid, like, I don't know, rent or salary or whatever, and something that I didn't pay in this year because it's depreciation. I don't need this style. And by the way, you can always find information about depreciation in the reports like that, in the cash flow statement. But that's not important right now. So I don't like something in my income statement, because my income statement is the first step to the cash flow statement. And as I just said, sometimes I don't even have this second step. So the income statement will be the only financial report in my model. And that's why I don't mix depreciation with all the other lines of my costs. And that helps me to calculate an important indicator in my income statement, EBITDA, earnings before interest, tax, depreciation, and amortization. EBITDA will be used for many decisions by investors, by debt holders, and so on. So this is very important to have EBITDA in my financial report. So this is how my financial report look like. We start with our sales and our revenue and costs, and each line is a link to a section in our input data. Then we add depreciation. Depreciation is from our capital expenditure part. EBITDA minus depreciation gives us EBIT. EBIT isn't that important parameter for investment projects, but if you add it, that's good, that's okay. Then EBIT minus interest expense gives us profit before tax. Then we have income tax and net profit. This is pretty much a standard structure for any financial model for a project. Okay, and with this structure, and you can see that each line here is either calculated like here within the table, or it's a link to some section in our project sheet. The next financial report is, as I said, this is the most important financial report for our model. Although sometimes we just don't have enough data to fill it, and we skip this report, or just calculate free cash flow as a line in our report. And with cash flow statement, we actually have a choice. And here in my model, I will show you a difficult choice, a difficult version of choice, but I will show you an easier version as well. So for the cash flow statement, we have two possible styles of this cash flow. There are direct cash flow statements and an indirect cash flow statements. What's the difference? This is how the direct cash flow statement look like. In our operating cash flow part, we start with, it looks actually quite like our income statement. We start with cash received from customers, cash paid for raw materials, cash paid for our other fixed operating expenses, cash paid to employees, to banks, to the state, and so on, right? And this line shouldn't exist in a direct cash flow statement. So actually this cash flow statement isn't a real cash flow statement. This is something that looks like a real cash flow statement, but it isn't. Well, this direct cash flow statement would be a very good source of information for anybody who would analyze this project. And what's the key thing that this type of cash flow statement adds to our project? Let's compare these two cells. What do you think? Maybe somebody could comment on that. What do you think? Why sales revenue for 2025 isn't equal to cash received from customers in 2025? Can anybody comment on that? Depreciation? No. Credit cards. And what's credit cards in terms of our cash flow? Or yes, people paying later. It's not necessarily credit cards. It's actually accounts receivable, right? Because maybe it's B2B project. But first possible reason is accounts receivable. Right. And there is one more reason. One more reason is value added tax. This is a very interesting, and you should think about value added tax in our projects. And here, actually, in this case, you can see that we received more cash than we reported as our sales revenue. And that's because of value added tax. Because we received cash. This is actually, that's a cement plant. This is a B2B project. So we sell to businesses, and we receive money including VAT, right? What happens to VAT in our projects? And should we actually put VAT payments in our projects? And why? In many cases before, I guess you saw that in financial models, people ignore VAT at all. What happens to VAT? When I sell something for 100 rubles without VAT, then actually I receive 120, right? Including 20% of VAT. 100 rubles is my revenue. This is what I report here. But what happens to 20 rubles? I put this money on my balance sheet, and then after some time, monthly, sometimes quarterly, it depends on the company, on the jurisdiction, several factors. After some time, I calculate total balance of all VAT received from all my customers and all VAT paid by my company to my suppliers, and I return the difference to the state, to the government, right? This is how VAT works in my operations, in operating activity of the company. And because this is in a normal business, in a stable business, I receive more money from my customers than I pay to my suppliers. So this VAT, I always receive in any period, I receive VAT in excess of the amount that I paid for the same period. So this is just a matter of some time when I have this excess money on my account. I don't do anything with this VAT because I understand that in 2 weeks and 3 weeks, I will have to return this money to the state, right? And that's why in models like business valuation models and like that, in any model for a stable acting business, we just ignore VAT. We just can build this model as if there's no VAT in the world. This money just flow through the company, and we don't do anything to this money. But with the investment project, there's something important, and this important thing is this part. During the construction phase of the project, we don't have any sale. We don't sell anything. That means that we don't receive VAT, right? We just pay VAT with our capital expenditure. And this cash outflow is huge as compared to our future sales revenues and so on for most investment projects. And with this money, we will pay a lot of money as our VAT. For example, in this case, we have like 8 billion rubles as our capital expenditure. And of that 8 billion rubles, about 20% is our value-added tax, right? If we ignored this value-added tax, we would underestimate our necessary finance, right? Because yes, we can when we pay too much VAT, I mean, when we paid more than we received as VAT, we can ask the government pay back this VAT to us. We can fund our VAT payments, but those repayments take time. Sometimes it actually depends on many things, on the country, on the accounting principles, on many things. Sometimes it take like 6 months or a year to get this investment in VAT back. Sometimes you will wait until you finish the construction. And sometimes, even after that, you cannot refund all the VAT, and you will refund it gradually during your operating phase. So we cannot ignore VAT in our investment stage. But if we don't ignore VAT on the investment stage, that means that we should model VAT for the whole project. And that forces us to calculate VAT payments during the operating phase as well. Yeah, yes, we can avoid it, but the model would look better if we present VAT for all lines of cash statement where VAT exists. It just makes everything more standardized. So it's easier to read this financial report. Well, so because we have this construction phase, and during the construction phase, we should understand how much should be spent to finance our VAT payments. We added VAT to all lines of our cash flow statement. And this is the first difference. Now let's go to the second difference, the difference you actually mentioned, the difference due to accounts receivable. Let's check what we have as accounts receivable in our project. Last lecture, we prepared everything, right? And for accounts receivable, we have like 3 days. So we have 3 days delay in our financial report. Now, we understand that we want to show this 3 days delay in sales revenues as compared to in cash received from customers as compared to our sales revenue. Would you imagine a formula that we use to model it? So our calculations are by years. Now, how would you include this 3 days delay in these calculations? It's a bit hard, right? It would be even harder. Here you could say something like, okay, 3 days is that means that 3 over 365 should be excluded from these sales, right? And 3 over 365 should be included in the sales of 2026, right? But at the same time, some part of 2026 revenues should be transferred to 2027 and so on. But that would create a very complicated formula, actually. And for some cases, that's okay with accounts receivable. But what if we check here and no, we don't have it's here, but what if we have some advance payments? How would you calculate advance payments if we have 7 days of advance payments for our sales? What would you do here? That would mean, if we still try to calculate it day by day, that it would mean that we should present some sales revenue in 2024, because if we started in 2025 and we believe that all sales are evenly distributed within the year, that would mean that first 5 days or first 7 days or whatever of our sales are in 2024, right? And it would look very strange. We would create a very complicated formula, and it would be very hard to track these calculations. That's why people actually don't do that. Instead of creating such formulas, we decided that we just calculated how much money would be frozen in each line of balance sheet. For example, for accounts receivable, yes, we have some sales in 2025, but 20 million of those sales are frozen in our accounts receivable. How would you present this 20 million in your cash flow statement? We add them in our balance sheet, then we calculate how net working capital is changed in this year. In that 78 million of changes, we present as our change in net working capital. So actually, I reported all cash flows by the same items as in the income statement, and that helps to the user of this financial report quickly find the source of any line in my cash flow statement. Like if I'd like to find cash paid for raw materials, I put my selection here. I see that, okay, in this line, I can find this information. But I deal with working capital, with all those delays, advance payments, inventory, and so on, through the change in net working capital. And that actually makes my financial report, my cash flow statement, visually a direct cash flow statement, but technically it's indirect cash flow statement. What's the indirect cash flow statement? Let's look at the analyst handbook here. The cash flow statement here looks a bit differently. Let's check cash flow from operations. You can see that in the cash flow from operating activities for this company, they don't have cash received from customers or cash paid to anybody. Actually, they have a lot of special lines here. We exclude them all, and we will just keep 1 second. We will keep the lines that would appear in our financial model. That would be we hide this. That's how the indirect cash flow statement look like. We start with profit. Here it's before income tax because they account for differences between income tax accrued and paid. But we would start with profit, with net profit, profit after tax. Then we add back depreciation to this profit after tax. And then we model all changes in the working capital. Sometimes companies and we can present it line by line as we did in our working capital section. Sometimes we can just collect all this information, calculate total change in net working capital, and add one line change in net working capital. So that would make our model simpler. And with this approach, we would have like just 3 lines in our cash flow from operating activities: net profit plus depreciation minus change in net working capital. And that's not that convenient to analyze what we have in our financial model, but it's much easier to build the model like that. And you can see that even with my imitation of direct cash flow, when it comes to the working capital, I can't do anything. I can build the formula that calculates all changes in my working capital, all these offsets of payments like accounts receivable and so on, and I calculated this just as net working capital. Okay, so to sum up, in the cash flow statement, you have a choice of building a cash flow as an imitation of direct cash flow or as an indirect cash flow. Indirect cash flow is simpler. Direct cash flow, even this incomplete direct cash flow, is easier to read for people, because no matter where you start, here, on here, or here, you can quickly find your way to the input data and to all calculations for this financial report. 2 other parts of the cash flow statement are simpler. They are standard. They are the same for direct and indirect cash flow. Cash flow from investing activities are all our capital expenditure. And because we had several lines in our several blocks in our capital expenditure part, it's better to build something similar here. Like if we had land, buildings, equipment, other startup costs, it's better to have the same lines here. Although you can see that even in this parts, I have 2 lines in my financial report, and that's not the best style. The best style if you have just one link, but this is something acceptable. If you, for example, if you have 2 or 3 actions in your initial data, in your intermediate calculations, and you want to sum them here, you can do it. That still doesn't create a big trouble for those who read your financial report. But you should never do any serious calculations, any serious calculation in your financial report. For your financial report section is to collect all the information prepared somewhere else. And the last is balance sheet. And you can build a simple, a very simple balance sheet for your model. Sometimes you even don't need any balance sheet. Here I built quite detailed balance sheet for my model, but basically you need a balance sheet, and I can show you why. One of the important information that the balance sheet conveys to you is this comparison. If you prepared a correct balance sheet, then you have total assets equal to total liabilities and equity, and that shows you that you build these two financial reports without an error. And this is important because you will be making errors all the time. And it's important to have something that will show you that, that something's wrong in your model. So the balance sheet is not just for the reporting. And actually, I've seen a lot of cases where people studied financial models, and nobody actually starts with reading the balance sheet. So the balance sheet is not that much for the reporting, for the analysis. It's just to make your model complete and to make it easier to see that everything's right, and to make it easier just to collect all information used in your cash flow statement and in your income statement. So the balance sheet is more to make your model more stable. But anyway, it's an important thing. It's an important part of your financial model. And this is what we add to most financial models. Now, the first thing we do in our model is we build a template for our 3 reports and link those templates within the model, within the report. Do things like, for example, cash flow from operating activities. Even before we link all the lines here to our project sheet, we can say that yes, cash flow from operating activities is the sum of all these lines. So we fill the formulas for items like that. Change in cash is our 3 sections of cash flow. Cash at the beginning of period. Look here, we use our technical column to have the same formula for the first column, for the first period here, and for the other periods. We'll cash at the beginning of period to cash at the beginning of the previous period, although it's just empty here, and so on. Only 2 lines in our financial reports link to the other financial reports in the cash, not in cash flow statement. In financial, in the balance sheet, we have a cash item, and this cash item is equal to cash at the end of period, of course, in the cash flow statement, right? And another link is the retained earnings. Retained earnings is equal to what we had in the last period, in the previous period, plus net profit of the income statement. You can see that we don't model dividends. This is a standard approach for models for projects, because in a project, we are not that interested in how we pay dividends, because actually all free cash flow created by the project is ours, right? We can take these dividends or reinvest it in some other project or do whatever we want with this money. So it doesn't matter when we paid this as dividend, because for this investment project, we look at this from a position of investor owning 100% of this project. This is just a standard case. Sometimes there are several investors in the project, and we still need to calculate how they distribute profits and how all things like that happen. But in most cases, we don't do this. So all free cash flow for this project is ours. Well, now the first step is to build these standard financial reports and create all formulas that can be calculated inside those three reports. Next step is to link each line of the report to a correct line from our project sheet. For example, sales revenues. Where are sales revenues in our input data? There's a sales section. At the end of this section, we created all the lines that we use in our financial reports, and you can easily see that revenue in the income statement net of VAT is something that we will use in our financial reports. The same way, in the cash flow statement, cash received from customers here, we created a specific line, cash in the sales in the cash flow statement. And by the way, it's actually better to call to name this this line exactly as it here, cash received from customers. It helps people again to navigate through your financial model. If items with identical content have identical names. Okay, so we linked all lines of our financial reports to the project sheet, and now we can go down in this project sheet, and let's look at the tax payments section. We had 3 taxes in this project. Property tax, it's calculated based on net assets, net fixed assets. So we create a line fixed assets. By the way, we don't link in this case. If we can avoid linking to the results, to the financial reports, if we have necessary information here, we avoid it. So fixed assets is something that we calculated here for our for our buildings and structures, and we use this number to calculate property tax. We repeat the line with necessary assets. We repeat the line with tax rate. It actually comes from our marker sheet, and then we calculate our property tax. The same way we collect and repeat all information on value-added tax. Here we repeat all the lines from all sections of our project sheet. Cash received on sales, on raw materials, on operating expenses, paid on fixed assets. We collected all this information, then we calculate total VAT balance, and then we decide what should we do with this VAT. And again, as I said, it's very easy to deal with value-added tax if you have stable operations, because each year you receive more VAT than you paid to your suppliers, and by the end, like here, for example, by the end of the year, look at 2028, we received some VAT from our sales, then we paid some of that as VAT with for our suppliers. We have 600 million of VAT that we pay to the state, pay back to the state. So that's very easy. But during the construction phase, this number of total VAT is negative. And you should show somehow that you have to finance this VAT. In this case, in my model, I decided that I will be refunded for this overpaid VAT the next year. So I will have to finance it for 1 year, and then the next year I get it back. I made it just to make my formula not very complicated. So I have VAT as asset. This is the number I will present in my balance sheet. So for 1 year, if I have negative VAT, then for 1 year, this number will be put on the balance sheet, and then just only on in the next year, I will get this money back. That means that for this amount, for 1 year, I will have to get debt or equity to finance this asset. And you can, of course, build a more complex formula. You can create a formula, for example, to be refunded after the construction phase, or to be refunded not directly by a payment from the government, but from the amount of VAT overpaid or paid to you from your customers when you start sales. It depends on your legal circumstances and your business. So we created first this calculation for property tax, then second our fee. The last tax we used here is the income tax. And for the income tax, here we don't have choice. We have to link it to the income statement. It's from, you can see it's income statement line 14. It's our taxable profit. Now, for this taxable profit, you should be careful. First, what should you do if you have negative taxable profit? You can't get negative income tax. You will not be funded by the government if you have losses, right? So at least at the very minimum, you have to, in your calculation, you have to put a limit so that your income tax would not be negative. But actually, here the model here and the business here is pretty simple. We have no profit during the construction phase, and then we have profit during the operating phase. But sometimes maybe some expenses were presented during the construction phase, or we have some initial period in the project where we have losses. We started operations, but we have losses. During that period, our income tax will be 0. That's pretty simple. But what would happen after that? What if we have something like this? Let's do it. What if we have our general expenses, for example, started here, And now, in the income statement, you can see that we have losses in 2024. What would happen to our income tax when we started getting profit in the next year? Well, our prior period losses, let's go back to taxes. Our prior period losses could be used to offset these newly earned profits. So we don't have to pay 20% of the income tax for all our losses. And for some projects where we have a lot of prior period losses, this is a very important factor. We should not ignore it. So we have to build a formula to accumulate our prior period losses when we have negative taxable profit. And then we subtract these prior period losses from the taxable profit. I will put the model in the folder on the internet. Well, in my folder where I put all the information, so you can check this formula to see how you can calculate this prior period losses. But this is important, especially this is important when your project is started not with capital expenditure like buying equipment, but you have some initial periods of losses until you can penetrate the market. Because with projects like that, you have a lot of losses, and then when you start getting profits, your taxable profit will be actually less than calculated directly in the period. So this is the last step here to calculate our taxes. Our income tax, we put directly in our income statement, right? Then our property tax, we can put this property tax in a separate line, as I did here, just because it's easier, again, from the standpoint of reading the model. Maybe this is not a very important line, but it just leads you to a separate section of the project sheet. That's why I have a separate line here. Or you can add it to general expenses, but it makes your navigation a bit more complex. So we put direct property tax here, income tax here. We don't have any place in our income statement where we present VAT. VAT isn't used in the income statement at all. In the cash flow statement, we put, before that, we put paid value added tax in each line of our revenues and expenses. But then we should show all our payments to the state. And here we just collected all three taxes from our tax section. We could, again, we could calculate it as something like total tax payments. Here, probably it would be better. So we collect all three taxes here. And now in our cash flow statement, taxes paid would be just a link to this payment, something like this. this is a better style. In some places of this model, I didn't do it in the best possible way, but you can easily see how to make it better, right? Something like this. And we can quickly check if it's still okay. Our balance sheet is in balance. That means that probably we didn't do anything wrong with this change in our calculation. Okay, and this is the last part of our financial reports. So let's quickly repeat the main ideas. First, your financial reports go usually after your input data, after your intermediate calculations, and those financial reports should be as standard as possible for your type of project. Second, try not to calculate anything within your financial report section, within your financial reports. A perfect line in a financial report has just one link to a section in your intermediate calculation sheet or in your input data sheet. It depends on how you structure your model in a style where you have input data, then intermediate calculation, then financial reports, or as I did it here, where I mixed the input data and all intermediate calculations. But a perfect financial report have just a link. You have to try to build all three financial reports for your project, not because all this information is very important for your analysis, but just to make it easier to digest your model for any user who didn't discuss it before with you, who didn't know before anything about your project, and who opens it for the first time, and in most cases starts analysis, starts reading this model from your financial reports. Next, our income statement usually doesn't look like an income statement of a reporting company, because we need more details here. It's very important for us to have EBITDA line in our financial report. We want to present depreciation as a separate line in our financial reports, and because we want to have a direct link to a section in our input data from or intermediate calculation from this report. Next, our cash flow statement is usually technically an indirect cash flow statement, because it's impossible to build a real direct cash flow statement without really crazy formulas to calculate all these offsets by several days for our payments. So our cash flow statement is actually indirect, but in some cases we present this cash flow like if it's a direct cash flow. Just again, to help people start from this cash flow and find all the information in our input data or intermediate calculations. And the last, even if you don't need the balance sheet, for your analysis, is a good style to have the balance sheet in your financial model to help you find to see all possible errors in your calculation, and just to make the whole model like more normal for for the users of your model, of your reports. That's it. Okay, so we were done for today. Now we have time to discuss your models if you need, or you can again send, just like you did it this week, you can send the models, or you can discuss them right now, especially if you have questions that could be interesting for the other students. You can ask now. If not, then I expect that by the end of next week, I will see your models, and not like 5 or 6 models that I saw this week, but at least 27, I expect, or 30, including those 3 students who didn't choose the project. I hope you do it now. And by the end of next week, I'm going to discuss your models with financial reports. Now, any questions? Okay, if not, see you next Friday. We'll be discussing financing the project, I believe, and send your models. Let's discuss your models.
I had a question actually. I was wondering if the balance sheet was necessary for the financial model, or we can just build the cash flow for the project.
As I told you, you can build a cash flow. Usually, if you don't need the balance sheet, you still start with the income statement. So the income statement is a very useful thing to have in your model. But yes, if you don't have a sizable amount of capital expenditure in the project, you probably don't need the balance sheet. So I would say that if you don't have working capital and capex, you should skip the balance sheet. If you have capital expenditure, if you have working capital, you definitely need the balance sheet.
And if I have capex but not working capital,
it's better to build a balance sheet. Some things like, for example, net fixed assets are important for people who analyze your project. And it's better to see them in the balance sheet, not in some intermediate calculations within your input data or within some other sheet. So it's better to build a balance sheet. The only thing is that your balance sheet will probably be a very simple one, maybe just like, I don't know, 6-10 lines. But still, you need it. You will see that you've calculated everything correct with your capex. The other people will see the actual amount of debt, assets, and so on in each period, and that's an important part of your reports. So simplify it if you will, but you need a balance sheet, some report. Okay, more questions? See you then. Bye.